Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shanghai Fudan Microelectronics Group Company Limited, latest report. Shanghai Fudan Microelectronics Group Company Limited offers a diverse range of products and services that cater to various industries. At its core, the company provides integrated circuit products and total solutions for international markets. The company's product offerings include security and identification products, such as QR code scanning modules, RFID and sensing technologies, and intelligence and security solutions. These products are designed to provide secure and efficient identification and authentication capabilities. In addition to security and identification products, Shanghai Fudan Microelectronics Group Company Limited also offers smart meter solutions, including automotive and ultra-low general-purpose microcontrollers, MCUs, smart meter dedicated MCUs, power line carrier technology, UHF multi-protocol RFID readers, and real-time clock chips. These solutions enable efficient energy management and monitoring. The company's product portfolio extends to bank cards, social security cards, smart transportation cards, and EPLC solutions, which provide secure and convenient payment and identification capabilities. Furthermore, Shanghai Fudan Microelectronics Group Company Limited offers issuance and validation services for these products, ensuring seamless integration with existing systems. Overall, the company's comprehensive range of products and services makes it a leading provider of integrated circuit solutions in mainland China and internationally. Shanghai Fudan Microelectronics Group Company Limited market capitalization of 60 billion is significantly larger than the average industry peer of roughly 2 billion. This shows that Shanghai Fudan Microelectronics Group Company Limited holds a significant advantage in their industry. Shanghai Fudan Microelectronics Group Company Limited trades at a higher price-to-earnings ratio of 60 times and a higher price-to-book ratio of 4.12 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 28% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various market trends and company performance. On the growth side, the increase in sales revenue, particularly in high-growth areas such as security and identification chips, plus 8%, smart meter chips, plus 31%, and FPGA and other products, plus 25%, have significantly contributed to the overall revenue growth. Additionally, the expansion of new energy and electric vehicle charging station sectors for residual current protection chips, recognition from overseas clients for fault arc protection chips, and significant results in technological innovation by Sino ICS testing services business have also driven growth. Furthermore, the company's principal businesses revenue increased by 10.7%, and sales to external customers rose by 11%. The highly reliable product sales portfolio saw a remarkable plus 30% growth, while radio frequency identification, RFID, and sensor chips experienced increasing market share due to continuous innovation and growing demand in various sectors. On the decline side, the loss on investments by equity method increased by 62%, and assets impairment losses rose by 159%. The NOR flash products witnessed a decline in sales across 3 core sectors: displays, wafer-level packaging, and security surveillance. The non-volatile memory market faced fierce competition, leading to decreased revenue. Other income declined due to reductions in VAT deduction and special government subsidies for R&D projects. The net income of the company has experienced a significant decline, with a decrease of 63.8% and 59.42% compared to previous periods. This substantial drop in net income is a cause for concern and warrants further investigation. A closer look at the profit margins reveals that operating profit margins have taken a hit, decreasing by 67.1%. However, gross profit margins have remained relatively stable, indicating that the issue lies not with the company's ability to generate revenue from sales, but rather with its operational efficiency. The disparity between these two metrics suggests that the company may be struggling with increased costs or inefficiencies in its operations, which is contributing to the decline in net income and operating profit margins. The company's financial performance indicates a significant milestone. One key indicator of this success is its ability to generate positive operating cash flow. This achievement signifies that the company is able to cover its operational expenses and invest in growth initiatives without relying on external financing. This positive development has several implications for the company's future prospects. It suggests that the business model is viable and the company can sustain itself over time. Furthermore, it provides a solid foundation for long-term growth and expansion. The ability to generate positive operating cash flow also enhances the company's creditworthiness and flexibility in making strategic decisions. Overall, the generation of positive operating cash flow is a testament to the company's financial discipline and operational efficiency. It is an essential factor that contributes to its overall success and provides a strong foundation for future growth and development. The company's debt level has undergone significant changes over the past year. While short-term borrowings decreased by $395 million, long-term borrowings increased by a substantial amount of $397 million. This increase in long-term borrowings is offset by a decrease in total current liabilities by $518 million. Furthermore, bank borrowings also saw a notable reduction from RM 1,000, $665 million to RM 1,000, $475 million. However, the interest expenses have shown mixed results. Finance expenses increased by approximately $3 million, while interest expenses actually decreased by around $4 million. This discrepancy raises questions about the accuracy of the financial statements. Despite this inconsistency, it is clear that there has been a change in the company's debt level and interest expenses over the past year. The performance of various segments and regions within the industry has shown mixed results over the past year. On a positive note, the design segment in mainland China has experienced significant growth, with revenue increasing from $3,388,010,913.84 in 2024 to $3,797,884,188.58 in 2025. However, other segments have not been as fortunate. The testing segment, which includes integrated circuit testing services, has seen a decline in revenue, dropping from $202,212,914.39 in 2024 to $184,376,912.94 in 2025. This trend is also observed in the others category, where revenue decreased over the same period. Overall, while some segments have shown improvement, others continue to struggle with declining revenues. Management is expressing a cautiously optimistic outlook for the company. While there are no specific details on their strategy, several indicators suggest a mixed performance. On one hand, revenue has increased by 11% year-over-year, indicating growth in certain areas of the business. However, operating profit has decreased by 63%, resulting in a net loss in minority interests of RMB 30.7 billion. In terms of specific product lines, management notes strong performance in security and identification chips, driven by increases in production and sales volume. Additionally, smart meter chip sales have seen growth due to expanding application areas, increased market share, and rising production volumes and inventory levels. Conversely, FPGAs and other chips have experienced a decline in sales and production volume due to decreased demand for smart appliance chips. Despite these mixed results, management is confident in the company's ability to meet its daily operations and future development needs, citing sufficient cash flow. This suggests that while there may be challenges ahead, the company has a solid financial foundation to navigate them. The company has a history of paying dividends to its shareholders. In recent years, the amount paid out has been significant, with RMB 65,714,184 in 2025 and RMB 81,906,040 in 2024. The dividend per share has also fluctuated, with RMB 0.58 paid out in 2025 compared to RMB 0.8 in 2024. The company's commitment to paying dividends suggests that it is prioritizing shareholder returns and has a stable financial position. This can be seen as a positive sign for investors, indicating that the company is generating sufficient profits to distribute to its shareholders. Concerns about inventory buildup and supply chain disruption are evident in the company's financial report. On page 19, it is noted that there is a risk of impairment of inventories due to potential decline in demand and market competition. This has resulted in an impairment provision of RMB 1,636.5943 million. Furthermore, on page 20, the company highlights the uncertainty surrounding overseas supply channels for key raw materials, which poses a risk of inventory buildup. Additionally, page 26 reveals that inventory levels for critical materials were increased to ensure continuous and stable deliveries, indicating potential concerns about supply chain disruption. The report also mentions that downstream demand for certain products held in stock during the reporting period fell short of expectations, leading to an increase in provisions for impairment of inventories, page 27. This resulted in a decrease in the carrying value of inventory. In some product lines, such as smart meter chips and FPGA and other products, there was a decrease in sales volume and inventory level due to reduced production to consume inventory. Overall, these concerns suggest that the company is facing challenges related to inventory buildup and supply chain disruption, which may impact its financial performance. That concludes the financial summary for Shanghai Fudan Microelectronics Group Company Limited. Feel free to comment below, and I will be happy to answer them when possible.